wrong button, so that's all right. I'm just setting up my final little box this end, and then I'll be with you, and just need to mute one thing, and then we're totally okay. Oh, good. I'm glad. Yeah. Okay. Absolutely super. Well, a very good morning, and welcome to the morning after the night before, of course, on which I'm talking about the FOMC event. So it's nice to have a bit of relief that the market's just going into that pause mode. We now do have a little bit of clarity post the FOMC, and just having a look around to see how markets are responding in the immediacy. What we've seen is some extended downward moves in equity markets. We've seen bond yields moving lower. Taking a look at copper and crude prices, they've both fallen lower, and we saw some immediate upside in gold. It's just off some of the highs of the day. Now, just taking a look at the reasons for this risk-off trade, we'll just quickly look at, you can see how gold rocketed higher with the Federal Reserve saying they're going to keep negative interest rates. They haven't even begun to think about raising interest rates. So that's a very good environment for gold to benefit. So we saw some gold buyers on the off of that. Copper prices have been moving down to the ADR low of the day. We've also had WTI and Brent crude just moving lower on the session. So looking at the currency space, we've seen typical risk-off flows in the currency space. Downside in the commodity block, the Aussie, CAD, New Zealand dollar, and upside in the Swiss franc and the Japanese yen. The US dollar pair continues to be mixed. It's kind of caught in a tug of war, really, between two opposing issues. It's talked between, on one hand, the prospect of the Fed using yield curve control has longer term implications that US yields remain lower for longer. That's been weighing on the dollar. On the other hand, there's fears that the reopening of economies might spark this second wave of infections. So we saw out of the US, COVID-19 cases topping 2 million. Texas had their highest one-day case load of COVID-19 cases. California's hospitalizations at their highest level. Florida had their highest number of cases, about 8,500 odd, the most of any 7-day period. And the Federal Reserve also referred to this risk. So this is why we've got this, this push and pull going on with the dollar. So the dollar's caught in that push and pull mode between those two opposing forces. Now, for today, we've chosen our dominant currency sentiment pair to be the Australian dollar, Japanese yen. On these risk-off tones, we'd expect the Australian dollar to be losing value, and it has, and we expect the Japanese yen to be rising. Now, any return back up to this 76.65 region can be considered suitable for shorting. We've got some near-term resistance just above there. So if we see price moving back up into 76.65, that can be considered suitable for shorting, looking at targeting just above that 74 handle, just sort of 60 points to the downside. So that is the dominant currency sentiment pair that we have at the moment. The only thing to be aware of is that we are cautious on this downside bias, because although really there's been a bit of disappointment in the market, and the disappointment is that the Fed didn't use yield curve control. They haven't really, really put the fireworks underneath the market that was needed to see stocks really rally yesterday, and to absolutely force interest rates to be down. But they certainly said they're not even beginning to think about interest rates, and there could be opportunities for medium-term buyers stepping in. So medium term, we may see a case of buyers stepping in at some of these more extended levels. So just to be aware of that, particularly the dollar yen. Arno did a piece earlier. If we see price moving down to sort of the key support areas just below, that could be an opportunity for a medium-term upside bias. But at the moment, focusing on the intraday with the risk-off tones that are currently in the market, we would favour 76, 65 and above sellers just being aware that this is a cautious downside bias as the market's redigesting what's happening with the Fed. But the key thing is for the medium-term upside bias to remain is the Fed, they're keeping quantitative easing going. They're changing it from daily to monthly QE purchases of 120 billion. It's $80 billion of treasuries, $40 billion of mortgage-backed securities, and they're just keeping the liquidity in the market. So that's a dominant currency sentiment pair for today. Looking forward at the risk events we have, just don't forget to always check out this post that we have here, the daily risk event outlook. It's very helpful. The key event that we have coming up is the US jobless claims and the US continued jobless claims. And if we just take a look here at the expectations for the initial jobless claims are 1.5 million. Now, the initial jobless claims have been falling week on, week out. So that's what you'd expect. You'd expect that people with initial claims for joblessness will be getting lower as we're getting through the worst of COVID-19. So the market really is expecting that trend to continue. Just taking a look here at the actual, if you look here at the claims, so we're expecting a lower reading again today. Now, what would be potentially supportive for risk would be if we get a lower than expected minimum reading. So the minimum reading is 1.1 million. So a potential positive for risk would be anything below 1.1 million. And obviously anything above 1.8 million would really flow into that concern. One of the things the Fed mentioned yesterday was they kind of not brushed aside the non-farm payroll report, but they said they were encouraged by the non-farm payroll report. But Fed's Powell said in reality he expected people to lose their jobs for years. It would be years before people get their jobs back. So the Fed was not optimistic on the non-farm payroll data, which was that really stellar reading from last Friday. So employment will be important today. The other important, arguably the more important reading is the continued jobless claims, because that's telling you how many people are still out of employment. And just taking a look here at the, I'll get the right one. Just taking a look here at the chart, you can see that last week there was a little bit higher. So that was, that's going to be concerning the market. The market wants to see the continued number of people unemployed going lower. We want to see it going down. So yes, last week was a little pick up to the upside. That is a concern. So that will be a focus for today. So the minimum expectations are 18.5 million. So that would put it here. That's a good, that would be a good sign that US employment is starting to pick up and to recover. If we get anything below 18.5 on the continued jobless claims and a reading below 1.1 on the initial jobless claims, that would be supportive for risk sentiment. So that's a potential sentiment shift that we could get from the employment data. With employment being in focus at the moment, that is definitely one to keep looking at now. So for risks to turn to the offside further and accelerate, if we saw initial jobless claims above 1.75 million and continued jobless claims above 21.1 million, that could turn the risk off moves and give them more acceleration and strength. So in terms of economic data points, we've had a whole string of weeks where they've been less important. These data points are starting to become more important, particularly in light of the Fed's response to employment and the pessimism about employment from the Federal Reserve. The market will be looking quite carefully at the data to see whether they confirm the Fed's fears or alleviate the Fed's fears. And that could be a key catalyst for risk. But as you say, as I've said, what we'd want to see, we want to see both of them moving in the same direction for a potential trading opportunity. We want to see, and I think the best trading opportunity would be today if the risk-off tones are accelerated by initial jobless claims being worse than expected above 1.75 and continued jobless claims being better than expected above 21 plus million. So that would be the best opportunity out of this potential data point. Going back to the charts, just reminding ourselves that's the key currency pair we have in play for the day. Now, I'm just trying to think if there's anything else to mention. No, that is the main risk events that we have coming up. There isn't much else on the calendar. Oh, the last thing, obviously, don't forget, it's easy to forget that in this current market, there are still other risk events that are kind of circulating. So don't forget we have Brexit risks. Any negative news about the deadline is approaching now for the UK to leave the EU. End of June is the date that we have for a Brexit extension. So look out for any headlines on Brexit that could obviously move the pound and impact risk. US-China trade deals and tariffs and general tensions are constantly in the background between President Trump and China. So keep watching that. The general rule book with that is that words don't impact the markets as much now as actually actions do. So that's what the market's really focusing on, is actual trade actions rather than merely words. Also have the China-Australia trade tensions. That's bubbling away after Australia wanted an investigation into the origin of COVID-19, and that was felt as a threat by China. And as a result, there was a number of tariffs and penalties that were threatened to Australia. So look for those tensions there between China and Australia. And also the Euro Relief Fund, particularly with the Euro-US dollar pair. If we get any indication from the Frugal Four that they're backing away from the Euro Relief Fund and they're not prepared to have any part of the either the loans or the grants to member states, then that would obviously change risk sentiment as well. Because a lot of the positive risk sentiment has been that there's going to be QE from the Federal Reserve, China's economy is recovering, Euro is recovering with the PEP funds that's supportive of the European economy, and the Euro Relief Fund, that there's going to be money backing up, and supporting a potential recovery. So if we saw the Euro Relief Fund fall through, for instance, that would impact risk, and it would obviously flow through to a number of markets because of the significance of the Eurozone as a whole. So I'm going to go now to the question and answer panel. And so don't forget, this is your opportunity and your time to ask questions. And if you have any questions, please do ask them in the question and answer panel and the chat panel as we look ahead to what's coming up. Hi, Richard. Hi, Giles. Can you explain how government bond yields affect lending interest rates? What is the link to commercial banks? How does the government bond yield curve affect my borrowing costs from a commercial bank? I hope that makes sense what I'm trying to understand. Yeah, it does. So, Richard, the central bank sets the main interest rates, and then the commercial banks will be lending to one another and using that central bank interest rate. Now, obviously, by the time we get to our borrowing costs, the commercial banks would have taken, their cut. So with, yields on interest rates being really, really low and interest rates being really, really low, obviously we don't see those interest rate levels because other banks, higher up the food chain will lend to each other and then lend to the consumer, and every person takes their little cut. Obviously, the incentive is to try to offer the best rate as possible, and by offering the best rate as possible, you're obviously going to get more customers. So the incentive is to keep the rate, as low as possible. So by the central bank raising the interest, dropping the interest rates, commercial banks have their bottom line cut into, and the interest rates that they can charge to people lower down also drops as well. So there's kind of a knock-on effect, but it all comes from the central bank. And the government. The reason government bond yields are impacted by lending interest rates is because the government wants to borrow money as cheap as possible. So when the basic relationship between yields and interest rates is when yields are going up, interest rates are rising. When yields are falling, interest rates are more likely to fall. So what the governments want to do at the moment, this is the yield curve control, is Japan, Australia, and arguably the US. They're going to want to keep their borrowing costs as low as possible for as long as possible. So the last thing they want to see is their interest rates on bonds going higher, which leads to higher interest rates. There's a correlation between government bonds and interest rates. So the basic connection, Richard, is rising yields is rising interest rates are coming. Falling yields is falling interest rates are coming. So governments want the borrowing cost to be as low as possible because they've just borrowed so much money and so much stimulus, and they don't want customers and companies and consumers within their country to be faced with these higher borrowing costs. I hope that makes sense. I know Arno has done a video, Richard, on exactly that question, the link between commercial banks and interest rates. Again, just pop a question in the Q&A panel underneath one of the videos, and one of us will get a video over to you, Richard. I know Arno's done a video on that specific question. Hi, Rolando. Should we expect more US dollar weakness on the risk on tone? Yeah. Now, the thing with the dollar at the moment is the dollar has decoupled from the Japanese yen and Swiss franc recently. So we had been seeing the dollar acting as a safe haven currency. Okay. Now, with the risk of reflation and the reflation trade and the economy getting back going, that's been seeing the US dollar sinking. So and there's a tug of war with the US dollar. On the one hand, the prospect of the Fed's yield curve control is keeping the US dollar down, okay? On the other hand, the risks of second wave COVID-19 infections are keeping the dollar potentially bid as a safe haven. So it's going to get torn and stuck between this tug of war going on at the moment. So it's a little difficult to tell what the near-term direction of the US dollar is going to be. I think particularly it's going to rest a little bit on what's happening with COVID-19 and whether these second wave of infections in the US, which look concerning, given the fact that you've got larger numbers coming in from Texas, Florida, California, that's potentially concerning. So that's if we see COVID-19 cases come back in and the US economy is going to be struggling again, then potentially we expect that US dollar strength to come to the fore and move upside. If we get strong risk on tones, so say we get Aussie US dollar, New Zealand US dollar pound, we'd expect US dollar weakness on a strong risk on tones. So risk off, we'd expect US dollar strength. If it was a risk off that was really concerning, involving the US economy and COVID-19 in the US, risk on tones, we'd expect US dollar weakness. Abu Bakr, if the macroeconomic projection for inflation and growth given by the central bank is lower than they did present in the previous meeting, what would be the effect? Yeah, so if they were more negative than they were expecting, so say let's say the growth is going down, inflation going down, then we'd expect some stronger risk-off tones. So we expect yen strength, Swiss franc strength. We'd expect Aussie weakness, New Zealand dollar weakness. So we'd expect risk-off tones to come to ripple through the market with if inflation and growth is just dropping. That would be more downbeat terms, and that would ripple through the global economy. Lance, is it true that the Fed, or whoever is responsible, reported incorrect data in the non-farm payroll? This resulted in the unemployment rate being underreported by 3 percentage points at least, I have read. If so, is this now widely known? Has the market now adjusted pricing accordingly? Yeah, hi Lance. I also, have read some similar reports to what you're saying, Lance, but I haven't seen it taken up widely. So I think, yes, it's widely known, but it's not widely reported. So I haven't seen anything about that on the Bloomberg terminal, for instance. And if that was like a real big issue, I would have read a number of different articles on it. And I haven't seen anything on the Reuters feed either. So, whether that's the truth or not, I don't know. But I do know I've never seen a report that has been so unexpected as that non-farm payroll report last week. Like, I know one of my colleagues who works in Forex Live was so sure that the negative print was coming. He'd already put that the number was going to fall in the headline before he released it on the terminal, because he was that sure it was going to happen. So, that just tells you how, people were assuming it was going to be a negative number. So it just hasn't been widely reported. I think it's widely known. And I don't think the market has adjusted the price accordingly, because I think as part of the market doesn't really know what to do after that non-farm payroll report, because, it was so unexpected and so out of the blue. That's why we saw that quite a lot of consolidation and just, nothing much price action heading into the FOMC, looking for the Federal Reserve. So I think now that we've had the Federal Reserve speak, and they said that they were concerned about employment, Lance, and that Fed's pal said that people would be unemployed for many years to come. So I think looking at the Fed's response, that does tell us quite a lot, really, that the Federal Reserve is certainly not thinking, wow, wasn't May's non-farm payroll fantastic, and the US economy is getting back on track. And no, they weren't saying that at all. So I think that's, that's the main issue there, Lance. Hi, Paul. With the Australian dollar, Japanese yen, isn't there a weakness in the Australian dollar due to Australia-China and US-China tensions? Yeah, broadly there is, Paul. It's a perfectly legitimate question. Broadly, the pressure on the Australian dollar is linked up to tensions between Australia, China, and US, China. And the reason is all to do with Australia's economy. About 30% of Australia's GDP comes from its trade with China. Okay. And anytime those tensions flare up, the Australian dollar weakens for two reasons. Firstly, because it's a high beta currency. Secondly, because of its close links with China. And many traders will trade the Australian dollar as a proxy for the Chinese yuan. So trouble in China is trouble with the Aussie, and good news in China is good news for the Aussie dollar. So that's the broad relationship. So that is the big picture. But if you just zoom out, we've seen that the Australian dollar has been on an absolute rip recently. And you can see, look, it's just gone through this very key weekly trend line to the upside. You can see that's a critical break on that trend line. You can see price just testing that trend line to the upside. So the reason for the recovery in the Australian dollar Japanese yen pair is the stock market recovery that we've seen. So if you just take a look at the S&P 500, you can see that the Aussie yen pair, it goes in tandem with global stocks. So that's why it's seen as this, this global risk currency pair is the Aussie yen. It kind of gives you a good barometer as to what risk is like, okay? So if risk is on, Aussie yen upside, risk is off, Aussie yen downside. So the recent rally in the equity markets has been benefiting the Australian dollar. We've also had upside in the Australian dollar because alongside New Zealand, it's one of the best developed countries in dealing with COVID-19. So they've had some, they've been able to deal with it pretty well. So, but any tension between US and China, Australia and China, will result in further Aussie downside. And that's a constant pressure for the pair. And it's something you constantly need to be aware of, but only when it becomes relevant, Paul. So only when there's like a new headline. So say, for example, there's a new headline now when Donald Trump suddenly said, I'm going to bring in tariffs on China next month, and the phase one trade deal is off. Then that would be, an instant selling of the Australian dollar, Japanese yen. You could just sell that instantly on that headline, and then you'd be looking to sell any retracements back. But you need to have the fresh catalyst. So the reason for the Aussie yen downside today is not because of the US-China and the Australian-China trade tensions, although they're constantly bubbling away. That's not the reason for the fresh catalyst. It's just purely on these risk-off tones after there was concerns, economic outlook concerns by the Fed, COVID-19 cases topping 2 million in the US, and Fed referring to the risk of COVID-19. And then we've just seen throughout the market, we've just seen this very negative response. Equity markets red across the board, bond yields moving lower broadly than we've seen. Oil markets, gold, gold pushing higher with interest rates set to be low for a long time. Oil, crude prices both moving lower. Copper prices moving lower. Bond yields moving lower across the board. So that's why today we'd expect more downside in the Aussie yen. Aussie dollar, high beta status. So we expect that to be sold in a risk-off environment. Japanese yen, we expect that to find bids. And if you just take a look at the risk-sensitive pairs, you can see the yen strength across the board. You can see all these pairs are moving to the downside and heading towards the ADR lows of the day of the risk-sensitive pairs. And if you just take a look at the currency space, you can see we're seeing typical risk-off tones, broad commodity currency weakness, and Swiss franc, Japanese yen strength. Paul, I hope that helps. Abu Bakr, if the macroeconomic projection is negative than they present in their previous meeting, it will flow risk off. What will be the effect of the specific currency? Say if RBA present worse than they did in the previous, will it weaken the Australian dollar? Yes, it would. So if the Australian economy said that their growth outlook, their inflation outlook, that their macroeconomic projections are worse than expected, you'd expect that to weigh on the Australian dollar. Yeah, for sure, that would be a negative for the Australian dollar. And then on the day, Abu Bakr, what you'd look to pair it with a currency that had some reason for strength. So, that's what we'd be looking at. Hi, Jehoasim. Yeah, I'm looking to short CAD Swiss franc on back of lower oil prices. And I expect it to get even lower based on the inventories yesterday. That was a build. Yes. We have also the overall risk off. And as long as the risk off is going on in the market, that should support the Swiss franc that even has increased today against the Japanese yen. Okay, my entry level will be around 1.5. Right, let's have a look at that. Yeah, got it. Yeah, okay, let's have a look. So let's look at the CAD Swiss franc. And you're looking at 1. Canadian dollar, Swiss franc. Hang on. Okay. I'm getting a bit confused with your entries here. Let's have a look. This is the CAD Swiss franc pair. Entry level 1 point. I think just have a quick look, Jehosim, at the entry levels, because I think you may be looking at you might be looking at a new a different chart. So I'll just give you a moment to have a look at that. I'll answer some other questions in the meantime. No, you're welcome, Paul. No worries. Yeah. Hi, Giles. Missed your earlier assessment of the market. Can you briefly say something about that sell-off in relation to the NASDAQ? Thanks in advance. Yeah. So the tech-led NASDAQ, I mean, the only thing that I can really add to add, Mark, is that I think there was quite a lot of, I think the market was a little bit disappointed by the FOMC. I think there was a bit of a hope there would be some yield curve control, and I think if we had the yield curve control and QE was remaining the same, then we'd expect that to be, you know, bullish for stocks. So the fact that we've seen just stocks moving lower, I think part of this is there's been a, you know, let's just zoom out and look at the NASDAQ, and you can see that we're making fresh highs. And for those fresh highs to keep on going, I think the NASDAQ needed that extra, you know, that extra real boost of the Fed, you know, guaranteeing low interest rates by yield curve control, really just hammering down all borrowing costs to accelerate upside to the absolute maximum, you know, that V-shaped recovery for it to keep going on, more like a Nike tick than a V. So there's just a little bit of disappointment on that. Obviously, we've got some technical levels here. So this support level at this 97, you know, the previous highs, 9769-ish, that region here just above, that's going to be a key line in the sand going forward. But I just think it was part of it was a disappointment. Fed was a little bit you know, pessimistic, and we've had the COVID-19 cases bubbling away. And I had noticed, you know, a day or two the headlines have been building up and just been kind of ignored. And I think now the market thought, you know, we can't, you know, finally they got attention with a few headline grabbers, you know, 2 million cases, highest number of cases in a 7-day period, highest one-day count, a few records, you know, across the board has got the market's attention. So at the very least, we're expecting a pullback here. Now, medium term, nothing much has changed. The gravy train, the quantitative easing program, $120 billion a month, is still very much in play. So in one sense, nothing's changed. It feels like a breather. It feels like a little bit of a retracement before, you know, the rally moves back on to the upside. I hope that helps, Mark. So I can't be any more insightful than that. You're welcome, Abu Bakr. Mohammed, hi, what is ahead for Aussie US dollar? Will it sell off in sessions ahead, or low probability for that? Yeah. Now, just taking a look at the pair, what you can see, first of all, what you can see technically is price has just moved into this key overhead resistance level. Just taking a look at, you know, a trend line to give us an indication, you can see that price is just false breaking out of that upward trend line. So we're having a profit taking in this region. Now, the Australian dollar's rally has been in line with global equity markets. So I think the future for the Aussie US dollar is going to depend on the future of the global recovery. And the future of the global recovery is actually going to depend on how well COVID-19 cases are or are not avoided. That is going to be key. So I think in the near term, we'd expect a near-term correction in the Aussie US dollar because of these high prices here. Now, what would invalidate that outlook would be a move above these highs. So if we did get a move above these highs, that would invalidate the buy. So if someone put my gun to my head and said, which way would you say the Aussie is going to be going? I would favor Aussie downside, but I wouldn't have conviction on it to put a trade on. But if you were having to say which way the Aussie was going to go, you say the Aussie is due a correction at the moment. You've got a number of risk factors: US-China trade issues, Australia-China trade issues, global growth concerns, COVID-19 potentially having second waves of infections, and all those kind of issues are, very hard. So I want to show. Let me just show you two things. So first of all, I want to show you this is the graph of what happened in the Spanish flu of 1918, 1919. Had the first peak, and then the second peak came something like 6, 7, 8 months later in the US fall. Okay, and there was millions and millions of deaths in the US as a result of the flu, and in fact around the world. So what people are being, if you speak to people in the medical profession, so we have a friend who works in medicine, and what they're being told by the UK government is prepare for a second wave, probably around the fall. Okay, in other words, around sort of October, November time here in the UK. Because historically, that's what tends to happen. Now, this hasn't happened with SARS, it hasn't happened with MERS, because the viruses are not as contagious. Now, the Spanish flu was very contagious, and we do know that COVID-19 is very contagious. So this is another graph. This is the prediction by the Center for Infectious Disease Research. This was the prediction of what they're expecting, how the COVID-19 cases to go. So they are anticipating a peak just around the fall of this year. You see, exactly the same kind of thing. So if we get through this latest peak, then I think there'll start to be a lot of relief. Don't forget, there is a lot of people working on vaccines with hopes of a vaccine towards the end of this year. So the overriding market, to put this into the overriding market feel is that it's going to be okay. That's what we've been seeing in the equity markets. Okay. The fears on the other side are secondary outbreaks. Okay, but in the back of everyone's mind, people are thinking we're going to get a vaccine by the end of this year, start of next year. But just so you know, the path of the Aussie is going to be linked very highly to whether we bounce back from COVID-19 or not. Mohammed, I hope that helps to give you a little bit of context. Robert, this is TradingView charts. So it's a charting platform. It's very good. I really like it because you can just get, you can get multiple charts all on the screen, and really great. This major chart we have here is really great for just tracking the dollar and how it impacts the dollar, major dollar pairs. And then we've got ones for bond yields and for commodities. So it's really, really helpful. Good bit of kit. Mohammed, my sell entry was a bit low at 6912 with stop loss at 0.7007 with target 6864. Can you comment on this a little bit? Mohammed, right, I think you're meaning Aussie US dollar. Let's have a little look at that. Okay, so you were looking to short the Aussie at 6912. The stop loss at 0.7007. Yeah, can you comment this a bit? Okay, so yeah, absolutely. I'll show you a little trick. So when you've got a pair that you want to enter in, now remember that it could be a bit mixed pairing the Aussie with the US dollar. I would prefer to pair the Aussie with the Japanese yen, because the picture's just clearer. You got Aussie weakness and Japanese yen strength. It's just a clearer outlook, okay? But let's assume that this was the best pair to trade. I'll show you a little trick on this that's helpful. Okay, what you can do is, if you want to get a really low cost entry point, just draw a trend line of the major swing points. And what you can do is, here you had your entry at 6912, okay, with your stop at 0.7007. Yeah, that's like fine, okay. But the thing is, if this trend line, if your trade's going to go, this trend line has to break, okay. So one like sort of clever way in it is, you might say, well, I'll try 6912, and I'll put like a really tight stop loss on. So I'll put like a tight stop loss on of, say, like 20 points. So 69122232. Okay. So you're entering once, you're entered in, you're stopped down. Okay. Then you try another time. Just put your entry there and just put your stop 6932 again, and see if you get taken into the trade. Okay. If you get stopped out again, try a third time and then just leave it. So that's one way of getting into a breakout trade without having, like, you know, all that risk, sort of 80 point pip risk. So it's just a bit of being a bit clever. But the key to do it is entering multiple times. So only use it when you've got a fundamental bias for a pair and you're looking to trade a breakout of a trend line like this. Look, it's obvious. It's an obvious trend line, okay? You know, you could potentially even move it down there if you wanted to, you know, be more cautious. But otherwise, trade it like that. But as I said, I prefer the Aussie yen than the Aussie US dollar for today. But I hope that's a little tip, and I hope that does help. Jehoiakim, I met 0.700. Yeah, no problem. It's easy to get them. It's easy to get the pairs mixed up. Let's have a look. So let me just have a look where we're looking at. Okay, Kadshuf. Yeah, there we go. Okay, so your entry level about 0.700, and stop loss 0.7080. Yeah, I've got you now. I've got it. And TPRA 0.6910. Okay, so yeah, okay. Right, let's just have a little look at that. All right, let's see. Yeah, okay, so yeah, a couple of things about this. First of all, your rationale is good, okay? Oil prices they've been on a run for about 2 or 3 weeks, haven't they? And we had the build in inventories. You're absolutely right. And there's a number of different, you know, I was doing some research on Bloomberg this morning, and you know, there's inventory builds building up all over the place, and it does call into question the production cuts. So I agree with your logic. The Swiss franc is being bid on strong risk off flow. So your fundamental bias, great, Jehoiakim, well done. That's a good way of thinking. Now, looking at this from a technical perspective, again, you see, you've got this, you've got this trend line that's being broken, okay? So see what you could have done there, you see, you could have done that same trick that that same trick that I shared just recently. So just there, when you've got that fundamental bias, and you see that trend, it's got to be obvious. You know, it's an obvious trend line. So this is going to be this is like a turning point in the market. You see, so one sneaky way in is you just buy, sell on stop and put like a 20-point stop in, 0.7020, yeah, and then if you get stopped out, try it a second time, and then maybe try it a third time and just leave it alone, or enter on a deeper pullback. Your entry at 0.700 is perfect because it's just below that trend line there. So, and your stop above there, 7.080, is great because you're giving it plenty of room. Now, if price comes back into this zone, you want to think, if the situation remains the same, then you can hold that. Or if it changes, then obviously you can get out early. But I like that setup, and you're just coming through that trend. I like it fundamentally. I like it technically. Yeah, absolutely great. Really, really nice to see. Yeah, thanks guys. This is some nice little things that are being suggested here in the comments. So good work, everyone. Lucas, what do you think about Euro Swiss franc swing buy trade idea? Right, okay. Another Euro Swiss franc. Okay, and you're buying at 1.07. All right, so you're in the trade. Targeting 110. Yeah, technically target makes sense. Recent highs. Stop at 1.054. Yeah, not a problem with that. Although for the sake of it, you may, I think put it below. I would put the stop here below 1.048. A couple of reasons, because there is rumours that the 1.0500 is a soft floor for the Swiss National Bank. So I would just pop it under there. In other words, the level, we started to see Swiss franc deposits increase as we approached down to that 1.0500 level. And there was a bit of change in dialogue from the Swiss National Bank. They were saying, the Swiss is highly valued, and they changed their language, something like it's even more highly valued. I can't remember the exact terms, but basically there was a language shift that I'm remembering, just going back from my memory, on the Swiss franc, and it was this 1.0500 level. So stops below there on a swing. Now, in terms of the outlook for the Euro Swiss franc, right? The euro, we've got the PEP funds. That we had an extension of the PEP funds, euro positive. This will depend a lot on the Euro Relief Fund. If the Euro Relief Fund goes ahead and gets supported, then expect this to be bought up. If the Frugal Four, Lucas, suddenly say, we're not going to be supporting these loans and grants to countries like Italy and Spain, and we don't want them to be given grants. We only favour low interest loans, and if there's no loans, we're not going to agree to the fund. Then expect euro downside, and in that case, then I would just pull the trade. So the Swiss franc is strengthening on these risk-off tones. So if we see a second wave of COVID-19 and that really picks up, then you'd expect the Swiss franc to move down and down and down and keep strengthening. And remember, be careful of relying on the Swiss National Bank. That one candle shows what happened in 2015 when the Swiss National Bank said they were going to keep a 1.20 floor. So don't get deceived. If you're just recent in the markets, don't get deceived by any idea that the Swiss National Bank are definitely going to keep a floor. So be very, very wary of that. But if the economy picks up, COVID-19 falls down, we'd expect euro upside. At the moment, I'd say the euro has an upside bias, Lucas, and I think that's a legitimate reason for the trade. I've gone through the risks, COVID-19 kicking off, and euro area relief fund not working. stop. I just run the stop below 1.05, you know, for the sake of a few points, because let's be honest, if the circumstances change and you get a move down, you're going to be pulling this, the thing anyway. So I just leave it below the swing. Hope that helps. Okay, Joe, so you messed up all the prices. I was looking at several pairs at the same time. No worries. Okay, let's have one last look at that. Right, so looking at 0730 entry. Yeah, I like that. Near-term resistance makes sense. Stop loss 71110. Yeah, well out of the way. That's lovely. And take profit 0.6955. 0.6955. Yeah, the only thing I'd say is say price retraces up, Jehoiakim, to 7030 today, you're in. Target recent lows, okay? Because if you got to wait for those lows to break again, you know, you may not get it. You're looking at stop loss to break even at 6980. Yeah, okay. And then you're moving your stop to 6980. Yeah, I see what you're doing. Yeah, absolutely fine. Yeah, we've gone through a number of different ways to skin this cat, as it were, but that approach is absolutely fine. And the benefit is you've got your stop well out the way. You're taking a deeper retracements up, so it's good. Oh, Mark, yeah, okay. I should have mentioned I was long Wall Street prior to the drop, and so looking for its recovery and any trades I can get in on, assuming we've reached the bottom. Yeah. I just think it was that disappointment on the yield curve control, Mark. I think the market was, in one sense, it wasn't expecting it, but I think it was kind of hoping for it, and certainly that was a lot of the headlines that I was reading in advance was all focused around this yield curve control. So I think there was a sense of fixation, but the QE is carrying on. I think the key area for long Wall Street is that COVID-19. If we start getting second waves breaking out, you could see a pullback, and we have had quite an extension to the upside. So there could well be some profit taking. So I just keep an eye on the risk tone. But fundamentally, the situation remains the same. QE purchases are there, interest rates are low, the environment is supportive for stocks medium term. Yeah. Yeah, you're welcome. Okay. Sergey, thanks to your analysis and live squawk, I trade FOMC with confidence. First time in 2 years at 7 made 90 pips on EU and GU in the first 3 minutes. Great job, guys. Good. That's great, Sergey. Yeah, okay. Great. Guys, that's super. I've gone through all the questions for today. So thank you very much for your input, as per usual. It's been a really good session and some really good ideas coming up. So keep that up. Keep looking at how to take advantage of the latest risk-off tone and pairing currencies up. It's been good to see some of the thoughts you guys have been having. Guys, I hope you have a really good afternoon. I will be covering the afternoon session on the videos as well. So I will still be around if you want to get in touch or ping me a message. I'll try to get through as many questions as I can. Thanks everyone once again, and I wish you all a very good afternoon.